Right now, there are a lot of buyers sitting on the sidelines saying the same thing. I'm just waiting for mortgage rates to come down. But here's the reality. Even if rates drop, homes could still feel just as expensive, and in some cases, even harder to get. If you've been paying attention to the housing market, you've probably heard the same thing over and over again. If mortgage rates would just come down, homes would finally be affordable again. But honestly, that's not the full story. Yes, interest rates matter. Of course they do. But the rates are not the main reason so many buyers feel completely priced out right now. The bigger problem is home prices, monthly payment shock, and the fact that wages have not kept pace with the cost of buying a home. So this is not going to be one of those videos where I'm going to tell you the housing market is crashing tomorrow. And it's also not going to be one of those videos where I'm going to tell you lower rates are going to magically fix everything either. This is going to be a real conversation about why buying a home still feels so hard for so many people, even if mortgage rates improve. A lot of people see mortgage rates dip and immediately think, great, now homes will be affordable again. But that's where I think a lot of people are missing the bigger picture. The real affordability problem is not just the rate. It is the relationship between home prices and income. For decades, those two things moved somewhat together. Home prices went up gradually, but wages generally kept pace. That's not what has happened over the last 10 to 15 years. Home prices in the United States have risen dramatically faster than wages. In many markets, prices have increased well over 100% since the early 2000s, while household incomes have only grown a fraction of that. Another way to think about it is like this. Years ago, the typical home price was roughly 3 to 4 times the average household income. Today, in many parts of the country, it's closer to 5, 6, or even 7 times household income. That gap is a huge part of why affordability feels so stretched right now. Even if mortgage rates improve, buyers are still dealing with homes that cost far more relative to what people earn. And that disconnect between price growth and wage growth didn't happen overnight. It built up slowly over many years, especially after the pandemic housing boom, when prices jumped rapidly in a very short period of time. So when people say housing feels expensive today, they're not imagining it. The math really has changed. And the issue is not just borrowing money. The issue is how much a house costs in the first place. Lower rates help, but not as much as people think. Now, when mortgage rates come down, yes, that can help affordability. But I think some people act like a small rate drop is some kind of miracle cure, and it just isn't. For example, on a sizable loan, a rate drop might save a buyer a couple $100s a month. That's helpful, no question about it. But when the total payment is still very high, that savings does not suddenly make that home more affordable for everyone. And here's the other problem. A lot of buyers do not use lower rates to reduce their payment. They use lower rates to stretch and buy more house. That sounds great at first. Bigger budget, nicer house, more features, more space. But what comes with that? Higher utility bills, more maintenance, more repairs, more furnishing, more everything. That is where a lot of people get themselves into trouble. They focus so much on what they qualify for that they forget to think about what it actually costs to live in and maintain the home after they get the keys. Just because the lender says you can borrow more does not mean that you should. Real estate is hyper-local. Before we go any further, there's an important reminder that gets lost in a lot of these housing conversations. There is no single housing market. People love talking about the market, like every city, every suburb, and every neighborhood is experiencing the exact same thing. That's just not how real estate works. Real estate is hyper-local. So when you hear national headlines about prices rising, prices falling, bidding wars returning, or inventory improving, that might be true in one area and completely different in another. The market might not be your market. Even within the same metro area, conditions can change neighborhood by neighborhood and price point by price point. That's why buyers and sellers should be careful about making decisions based only on national headlines. What really matters is what's happening in your local market. If you are finding value from this video, please make sure to hit that like button, subscribe to the channel, and let me know in the comments what you are seeing in your area. Are homes still getting multiple offers? Are you seeing price reductions? Are properties sitting longer? Because again, real estate is hyper-local, and I think it's always helpful to hear what buyers and sellers are experiencing in different markets. The lock-in effect is still a huge problem. Another reason affordability is still such an issue is that inventory is still being held back by the lock-in effect. there are still a large number of homeowners sitting on either no mortgage at all or extremely low interest rates. And those people have very little reason to move unless they absolutely have to. Think about it. If someone owns their home outright or they have a mortgage rate under 4, why would they just give that up to go buy another home at today's prices and today's interest rates? Most of them won't. Then you have another group of people who bought in the last few years. A lot of them bought at elevated prices and higher interest rates. They have not owned the home long enough to build meaningful amounts of equity yet, so if they sell too soon, they might barely break even or even lose money after closing costs. So they're staying put too. And when all of these people stay put, inventory stays tight. That means buyers still do not have enough choices, and when supply stays low, prices stay more elevated than people expect. That is a big reason why the big dramatic crash that so many people have been waiting for so many years has not shown up yet. If rates drop more, prices could react. This is another part of the conversation that people do not always think through. A lot of buyers believe that if rates drop into the 5s or 4s, affordability will suddenly improve. But if rates drop and more buyers jump back into the market at once while inventory is still limited, what do you think happens? Competition goes up. And when competition goes up, prices can rise again. We have already seen how that movie ends. Low rates can absolutely improve purchasing power, but if more buyers are chasing the same number of homes, that lower rate can get offset by higher prices and more competition. So yes, lower rates can help, but they can also reignite demand in a way that keeps affordability from improving nearly as much as people would hope. The hidden costs are still catching people off guard. Now, this is the part that I think a lot of buyers still underestimate. The monthly mortgage payment is only part of the cost of owning a home. Taxes can go up. Insurance can go up. Utilities can go up. Maintenance is ongoing. Repairs are inevitable. And if you are buying into an HOA, those fees can absolutely rise too. Now, when you rent, a lot of those unexpected expenses fall on the landlord. When you own, they fall squarely on you. I think a lot of people, especially first-time home buyers, are still getting hit with that reality after they move in. They look at the principal and the interest payment and think, okay, I can handle that. But then the tax bill changes, insurance jumps, something major breaks, utility costs are higher than expected. Suddenly that budget that looked okay on paper starts feeling very tight in real life. And the numbers behind this are actually pretty eye-opening. One recent study found that the average homeowner in the US spends over $21,000 a year on costs beyond the mortgage, including things like maintenance, utilities, insurance, property taxes, and other ongoing expenses. Maintenance alone averages about $9,000 per year, making it one of the biggest hidden costs of owning a home. Financial experts often recommend setting aside 1 to 4% of your home's value every year for maintenance and repairs. So if someone buys a $400,000 house, that can mean budgeting anywhere from $4,000 to $16,000 per year, depending on the home's age and condition. And it doesn't even have to be a huge repair to start adding up. A water heater replacement, a furnace repair, a new appliance, a roof leak. Those things happen in real-life houses all the time, and they rarely show up at convenient moments. Then you add in regular maintenance like landscaping, gutter cleaning, HVAC servicing, and general upkeep. None of those things feel huge individually, but together they become part of the real monthly cost of owning a home. That is why buying at the very top of what you qualify for can be so risky. If there's no room in the budget for those real-life expenses, it does not take much for things to start feeling financially uncomfortable. The mortgage may be predictable. The house is not. Protect yourself during the purchase. The last thing I want to say is this. If you do buy in this kind of market, protect yourself. Do not get so caught up in trying to win the house that you make reckless decisions during the process. Do your inspections. Understand exactly what it is you are buying. Know the age and condition of the major systems. Pay attention to repair costs and maintenance concerns before you close on the home, not after. Because the fastest way to become house poor is to stretch yourself to buy the home, then walk into a pile of expensive problems the second you move in. So when you really break this down, the affordability issue today is about much more than mortgage rates. It's home prices, it's stagnant inventory, it's the lock-in effect, it's hidden ownership costs, it's payment shock, and it's the fact that lower rates alone are not enough to fix all of that. If you are buying a home, you need to stop paying attention to national headlines and understand your local market. Know your numbers and make decisions based on what you can truly afford long term, not just what a calculator says you can squeeze into today. So what are you seeing in your local market right now? Are homes still getting multiple offers? Are you seeing price reductions? Are properties sitting longer? Let me know in the comments below. Thanks for watching. I'm George Poporad, and I'll see you in the next one.